Welcome to the channel and thank you for joining today. In this professional session we are diving into the critical subject of saving strategies for July 2026. The financial landscape has become more complex with inflationary pressures, rising interest rates and shifting consumer behavior, and that means saving is no longer a simple matter of cutting costs but a structured discipline that blends foresight, technology and adaptability. In July 2026, finance saving strategies are more critical than ever as global markets continue to adjust to inflationary pressures, rising interest rates and evolving consumer behavior. The professional approach to savings requires discipline, foresight and adaptability, and in this talk I will outline key areas individuals and businesses should focus on to strengthen their financial resilience. First, let us consider the importance of emergency funds. A well-structured emergency reserve remains the cornerstone of financial stability. Professionals recommend maintaining at least 3 to 6 months of living expenses in liquid accounts. This ensures that unexpected medical bills, job loss, or sudden market downturns do not derail long-term financial goals. In 2026, with economic uncertainty still present, this buffer is not optional, it is essential. Next we turn to debt management. Rising interest rates have made borrowing more expensive, which means prioritizing repayment of high-interest debt is a smart saving strategy. Professionals advise tackling credit card balances and personal loans aggressively while maintaining consistent payments on mortgages and student loans. By reducing liabilities, individuals free up cash flow that can be redirected into savings and investments. Investment diversification is another critical topic in 2026. Global equity markets remain volatile and geopolitical tensions influence commodity prices. A professional saver does not rely on a single asset class. Instead, they spread investments across equities, bonds, real estate and alternative assets such as gold or digital currencies. Diversification reduces risk and enhances the potential for stable returns over time. Tax efficiency also plays a major role in saving strategies. Professionals should leverage retirement accounts, tax-deferred investment vehicles and government incentives to minimize tax burdens in many regions. Mid-year reviews in July provide an opportunity to adjust contributions and optimize deductions. This proactive approach ensures that savings are not eroded by unnecessary tax liabilities. Technology-driven savings tools are increasingly popular in 2026. Automated transfers, budgeting apps and AI-powered financial advisors help individuals stay consistent and informed. These tools provide real-time insights into spending patterns, highlight opportunities for cost reduction and encourage disciplined saving habits. Professionals who integrate technology into their financial routines gain a competitive edge in building wealth. Corporate professionals should also consider employer-sponsored savings programs. Many organizations now offer enhanced retirement contributions, profit sharing or stock purchase plans. Taking full advantage of these benefits is a direct path to accelerated savings growth. Ignoring such opportunities leaves money on the table. Deep analysis. In July 2026, the conversation around saving money has shifted into a more complex and layered discipline that blends traditional financial wisdom with modern tools and global realities. To analyze deeply, we need to look at how each element interacts with the broader economic environment rather than treating them as isolated tips. The foundation of savings today lies in liquidity management, but the nuance is not just about holding cash reserves, it is about balancing accessibility with opportunity cost. Keeping funds in low-yield accounts protects against emergencies but erodes value in inflationary climates. Professionals now emphasize tiered reserves where part of the emergency fund sits in instant access accounts while another portion is parked in short-term instruments that earn modest returns. This layered approach maximizes security while minimizing lost growth potential. Debt reduction strategies also require a sharper lens. Rising interest rates have changed the psychology of borrowing and repayment. In earlier years, refinancing was a common tactic, but in 2026 the cost of refinancing often outweighs the benefit. This means savers must prioritize behavioral discipline over financial engineering. Aggressive repayment of revolving credit is not just about saving interest, it is about freeing psychological bandwidth and reducing exposure to rate volatility. Diversification has matured beyond a simple stock-bond split. Professionals now view diversification as a multi-dimensional shield that includes geographic spread, sectoral balance and alternative assets. The rise of digital currencies and tokenized real estate has created new avenues, but these require careful vetting. The deep insight here is that diversification is not about chasing every new product but about constructing a portfolio that absorbs shocks from multiple directions. Tax planning in 2026 is more dynamic than before. Governments facing fiscal pressures are adjusting incentives and thresholds more frequently. Savers must treat tax efficiency as an ongoing process rather than an annual ritual. Mid-year reviews are critical because policy changes can quickly alter the optimal path. Professionals who monitor these shifts and adjust contributions early capture advantages that passive savers miss. Technology has become the invisible partner in savings discipline. AI-driven platforms now provide predictive analytics that forecast spending patterns and highlight inefficiencies. This is not just about tracking expenses but about anticipating behavior and nudging users before poor decisions occur. The deeper point is that technology is no longer a passive tool, it is an active coach guiding savers toward better outcomes. Employer benefits also deserve deeper analysis. In 2026, many firms are using enhanced savings programs as retention tools. This means that maximizing employer contributions is not only a financial decision but also a career strategy. Employees who align with organizations offering strong financial perks gain dual advantages: income growth and savings acceleration. Lifestyle choices remain the most personal yet most impactful factor. The deep insight here is that lifestyle discipline is not about austerity but about intentionality. Professionals encourage aligning spending with values so that every dollar spent reflects long-term priorities. This reframing transforms saving from a restriction into a conscious empowerment. Taken together, the saving strategies of July 2026 reveal a system where liquidity, debt management, diversification, tax planning, technology, employer benefits, and lifestyle are interconnected. Each element reinforces the other, creating a holistic framework for resilience. The professional saver today is not simply cutting costs but orchestrating a balanced financial ecosystem that adapts to uncertainty and thrives in complexity. Finally, lifestyle adjustments remain a timeless strategy. Conscious spending, reduced reliance on luxury consumption, and prioritizing value over brand names all contribute to stronger savings outcomes. Professionals in 2026 are encouraged to adopt minimalist approaches, focusing on experiences and long-term goals rather than short-term indulgences. In conclusion, saving in July 2026 requires a multifaceted professional approach: emergency funds, debt management, diversification, tax efficiency, technology adoption, employer benefits, and lifestyle discipline. Together form the foundation of financial resilience. By embracing these strategies, individuals and businesses can safeguard their future and thrive in uncertain times.